Chaikin Money Flow doesn't ask where price is going. It asks who's actually paying for the move. Volume, weighted by where each candle closes inside its range, summed over 20 bars. It's a stealth accumulation detector, and when it disagrees with price, smart money desks are often already positioned. Today, we dissect the math, the signals that work, the ones that lie, and how to stack CMF with trend tools for real confluence. Start with the money flow multiplier. Take close minus low, subtract high minus close, divide by the full range. The result lies between -1 and +1. Close near the high, you get a positive number. Close near the low, negative. Multiply that by the bar's volume, and you get money flow volume. Chaikin Money Flow is the sum of money flow volume over 20 periods divided by the sum of volume over those same 20 periods, a volume-weighted average of where price closes in its range. Think of CMF as a tide gauge at a harbor. The waves are individual candles, sloshing up and down, but the gauge measures whether the overall water level is rising or falling. A rising tide means money is flowing into the asset, even if individual waves look choppy. A falling tide means it's leaving, regardless of one big splash. CMF doesn't care about the loudest candle. It cares about the cumulative, volume-weighted direction of capital over the last 20 bars. Read CMF in 3 zones. Above 0 indicates net buying pressure, below 0 net selling. But magnitude matters. Readings drifting between -0.05 and +0.05 are noise. Sustained moves beyond +0.1 signal genuine accumulation, beyond -0.1, distribution. Extreme prints near +0.25 or higher often mark climactic buying, which paradoxically precedes exhaustion. Always pair the level with how long CMF has held it. Persistence beats magnitude. The cleanest signal is a zero-line cross confirmed by persistence. Wait for CMF to cross above 0 and hold for at least 3 bars before treating it as a long bias trigger. Reverse for shorts. A second signal, failure swings. If CMF dips toward 0 but refuses to cross, then thrusts back to fresh highs, that's accumulation defending a pullback. Exit when CMF crosses back through 0 in the opposite direction, or when it diverges from price for 5 or more bars. Divergence is where CMF earns its keep. Price prints a higher high, but CMF prints a lower high. Buyers showed up at the first peak. At the second, the rally is being sold into. That's bearish divergence, and it tends to lead price by 5 to 15 bars. Bullish divergence is the mirror. Lower low in price, higher low in CMF, meaning the sell-off is losing volume. Don't trade divergence alone. Use it to tighten stops or to anticipate setups from another tool, not as a standalone trigger. Here's a work setup. Price grinds sideways for 2 weeks, range bound between 48 and 52. CMF, however, has climbed quietly from -0.02 to +0.15. On bar 21, price breaks 52 on above average volume, and CMF ticks to +0.18. That's the trigger. Entry on the breakout retest at 52.2. Initial stop below the consolidation low at 47.8. The signal fails if CMF rolls back below +0.05, while price is still above the breakout. Volume isn't following through. Now Apple on the daily over the past year. Look for sections where CMF stays pinned above +0.1 for multiple weeks while price trends higher. Those are accumulation regimes, and pullbacks inside them tend to hold. Conversely, find a rally where price makes a new high but CMF can't reclaim its prior peak. That's the divergence playbook from earlier. The actionable read isn't the cross alone. It's the cross plus persistence plus a price structure. A higher low or a flag breakout, that gives you a defined invalidation level. CMF's strength is that it fuses 2 dimensions, where price closed in its range and how much volume backed that close into one number. Pure price oscillators miss conviction. Pure volume indicators misdirection. CMF answers both. It also normalizes by volume, so you can compare regimes. A CMF of +0.2 means the same thing in a quiet tape as in a frantic one. Now the weaknesses. CMF uses only the intraday range, so it ignores gaps entirely. A stock that gaps up 10% and closes mid-range can produce a tepid CMF reading despite massive money flow. It also lags. That 20-bar sum smooths out fast reversals. In low-volume stocks or after-hours-driven names, the denominator gets unreliable and readings whipsaw. And like every oscillator, CMF gives false signals in strong trends. It can sit above zero for months, and any zero-line cross is just noise. Confluence fixes most of those weaknesses. Overlay a 50-period exponential moving average on price. Only take CMF long signals when price is above the EMA and the EMA is sloping up. That single filter eliminates most counter-trend whipsaws. Add ADX above 20 to confirm a trending regime where CMF persistence is meaningful. For divergence trades, require a structural break, a swing high taken out or lost, before acting. CMF gives you the why, structure gives you the where. 3 pitfalls to avoid. First, don't shorten the period below 14 looking for sensitivity. You'll trade noise. Second, don't use CMF on illiquid instruments. The volume input has to be trustworthy. Third, don't conflate CMF with the Chaikin oscillator or the accumulation distribution line. They share DNA but behave differently. CMF is bounded and mean reverting around zero. The AD line is cumulative and trends with price. Mixing their signal logic will get you chopped up. To apply this tomorrow, pull up your watch list, set CMF to 20 periods, and tag every name where CMF has held above positive 0.1 or below negative 0.1 for at least 10 bars. Cross-check against a 50 EMA for trend alignment. Look for divergences on names extending into new highs. That's your short list. Test entries against the failure conditions we covered. This is education, not financial advice. Manage risk, size small, and let the volume tell you the story price alone can't. If this helped, do me a favor, hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.